The trade war between the United States and Canada, particularly if Canada shifts its trade alliances to other countries, like those in the European Union, Asia-Pacific, or within CPTPP, can have several negative impacts on the U.S. economy. Loss of market access for U.S. exporters. Canada is the United States' second-largest trading partner and a key export destination for U.S. goods, especially in agriculture, automotive, machinery, and chemicals. If Canada shifts imports to other countries due to tariffs or hostile trade relations, U.S. exporters lose access to a vital market. Sectors affected: agriculture, soybeans, corn, meat, auto parts, electronics, and machinery. Example: Canada could source agricultural products from the EU, via CETA, or CPTPP members, e.g., Australia, Japan, bypassing U.S. suppliers. Supply chain disruptions. The U.S. and Canada are deeply integrated through North American supply chains, especially in the automotive and manufacturing sectors. A trade war leads to higher tariffs, uncertainty, and regulatory barriers, disrupting just-in-time production and increasing costs for U.S. manufacturers. Impact: reduced competitiveness of U.S. products globally due to increased production costs. Retaliatory tariffs. Canada has historically imposed retaliatory tariffs in response to U.S. tariffs, e.g., on steel, aluminum. These hit U.S. industries in politically sensitive areas, affecting jobs and profitability. Affected industries: agriculture, whiskey, dairy, construction materials, and manufacturing. Reduced foreign investment. Trade wars create policy uncertainty, discouraging foreign direct investment, FDI, in the U.S. Investors may shift to more stable trade environments like the EU, Mexico, or Asia-Pacific countries, especially if Canada enhances ties with them. Erosion of U.S. geopolitical influence. Trade wars with close allies like Canada damage long-standing partnerships. Canada strengthening ties with countries like China, Japan, or EU nations may diminish the U.S.'s influence in setting regional trade norms. Higher prices for U.S. consumers and businesses. Tariffs on Canadian goods, e.g., lumber, aluminum, dairy, lead to higher input costs for U.S. manufacturers and higher prices for consumers. Example: U.S. homebuilders faced higher costs due to tariffs on Canadian softwood lumber. Job losses in export-dependent industries. Reduced exports and retaliatory tariffs can result in layoffs in industries dependent on Canadian demand. Missed opportunities in emerging trade blocs. As Canada deepens ties with Asia-Pacific, CPTPP, or the EU, CETA, the U.S. risks being excluded from new trade norms and supply chains, making its exports less competitive in those markets as well. The long-term effects may include a structural shift in trade flows, where Canada becomes less dependent on the U.S., and U.S. firms lose their preferential access to a historically strong and reliable market.